On January 31st, 2023, the most famous crash caller on the planet posted one word: sell. That was the whole message. Michael Burry, the investor who saw the 2008 housing collapse coming before almost anyone, the man they made a Hollywood movie about. He told his 1 million followers to get out of the market. The next day, he deleted his entire account and vanished from the platform. Millions of people saw that word. Plenty of them obeyed it. 2 months later, Burry came back and posted something you almost never see in finance. He wrote, "I was wrong to say sell." He was. The S&P 500 stood near 4,100 when he posted that word. Over the next 3 years, it climbed roughly 70%. The man who called the biggest crash of our lifetime told everyone to run, right before one of the strongest runs in market history. Quick note before we start: this is education, not financial advice, and nothing here is a personal attack. Every prediction in this video is public, dated, and documented. We're judging forecasts, not people. Here's the belief this video is about. Somewhere out there, a very smart person can see the next crash coming. He called the last one. He's on TV with charts. He sounds careful and serious, and next to him, everyone who stays invested sounds naive. Listening to him doesn't feel like fear. It feels like prudence. It feels like homework. And honestly, the wish behind it is completely rational. Crashes are real. They wipe out real savings and real retirements. Of course, you want a warning before the next one. Anyone would. But the warning industry has a track record. It's public, it's measurable, and once you've seen it, you can't unsee it. Start with an old joke that happens to be data. In 1966, the economist Paul Samuelson wrote that the stock market had predicted 9 out of the last 5 recessions. 60 years later, that's still the most accurate sentence ever written about crash forecasting. The warnings always outnumber the crashes, not by a little, by multiples. Here are the base rates. Since World War II, the US market has had a bear market, a drop of 20% or more about every 6 years. The average one cuts roughly a third off the market and lasts around 10 months. 10% drops arrive about once a year. 5% dips around 3 times a year. Falling is not a rare disaster. Falling is what markets do on the way up. So think about what that means for predictions. If you predict a crash every single year, the math guarantees you'll be right every few years. Not because you saw anything coming, because you never stopped predicting, and crashes arrive on their own schedule anyway. The trick isn't the prediction. The trick is that nobody counts the misses. So let's count them. And let's start with the strongest possible case, the man with maybe the best crash calling record alive. John Hussman, a former professor with a doctorate, running his own funds. In March 2000, he warned that tech stocks could lose more than 80% of their value. The NASDAQ 100 then fell about 83%. In 2007, he warned the S&P 500 could lose 40%. It lost 55%. 2 calls, 2 direct hits. If anyone on earth earned the right to be trusted on crashes, it was this man. So what happened next matters. Hussman kept seeing the next crash. All through the 2010s, he published warning after warning, at one point projecting losses of 50 to 70% for the S&P 500. The crash didn't come. His flagship fund, built to survive a disaster that never arrived, had 4 positive years out of 14. By recent counts, it had lost more than half its value since late 2010. Over the same years, the market it was hiding from multiplied several times over. Read that again. The man who correctly called the 2 biggest crashes of this century spent the next 15 years positioned for a third one. And the waiting cost his investors more than most real crashes would have. And this is a pattern, not one man's bad luck. Jeremy Grantham, a respected investor who genuinely saw Japan's 1989 bubble and the dot-com bubble coming, declared an epic bubble in January 2021. The market rose 25% that year. He then announced a super bubble and put fair value for the S&P 500 near 3,200, possibly 2,200. The index never came close to those numbers. It went up instead. Robert Kiyosaki, the Rich Dad Poor Dad author, has been announcing the biggest crash in world history again and again since his 2002 book first promised it. In April 2020, almost exactly at the bottom of the COVID drop, he warned the real crash was only beginning. The S&P 500 rose 53% over the following 12 months. He warned again in late 2023. The market kept climbing. Harry Dent went further. In 2011, he predicted the Dow would collapse to 3,000 points by 2013. Instead, 2013 became one of the best market years in decades. When COVID hit in 2020, he predicted a 90% collapse. The market fell hard and then recovered to new record highs within months. And it's not just the loud personalities, it's the entire forecasting profession. The IMF studied predictions across 63 countries and found that economists failed to call 148 of 153 recessions in the year before they happened. In October 2022, a Bloomberg model put the probability of a U.S. recession within 12 months at 100%. Not likely, certain. That recession never showed up. So here's the question that should bother you. If the track record is this bad and this public, why are the crash profits still on your screen every single week? Because they're not selling forecasts. They're selling a feeling. And the business numbers behind that feeling are spectacular. In 2023, researchers published a study in Nature Human Behavior. They analyzed around 105,000 headline experiments from a news site, the same stories, different headlines, shown randomly across hundreds of millions of views. The result: every additional negative word in a headline raised clicks by about 2.3%. Positive words lowered them. Your fear is not a side effect of financial media. Your fear is the product it sells. And the incentives only point one way. If a pundit predicts a crash and nothing happens, there is no penalty, no refund, no correction, no career damage. The prediction just expires, and next year he makes a new one. But if he predicts a crash and anything falls, he becomes the man who called it, and that title sells books, funds, and conference tickets for a decade. A wrong warning costs him nothing. Acting on it can cost you everything. Let's price that, because everything sounds dramatic until you run the numbers. Say the warnings work on you. You sell, you sit in cash, and you wait until it feels safe again. Here's what waiting does. Over the past 30 years, an investor who simply stayed in the S&P 500 collected the full return. An investor who missed just the 10 best days, 10 days, out of 30 years, ended up with roughly half as much money. Missing the 30 best days destroyed about 84% of the result. 30 years of outcome, hanging on a handful of days that nobody can identify in advance. And here's the cruel part. Those best days don't show up in calm, happy markets. Around 3/4 of the market's best days happen during bear markets or in the first weeks of a new recovery, exactly when the headlines are darkest, the profits are loudest, and you're most likely to be sitting in cash, feeling smart. You watched this happen recently. April 2025. New tariffs hit, and the S&P 500 lost more than 10% in 2 days, the worst 2-day drop since the pandemic. Every feed was screaming crash. Then, on April 9th, the index jumped 9.5% in a single session, the biggest one-day gain since 2008, sitting right in the middle of the panic. If you had sold into that fear and missed just that one day, you would have lost more than half of the entire year's market return. One day. Peter Lynch, one of the most successful fund managers who ever lived, said it in one sentence: far more money has been lost by investors preparing for corrections than in the corrections themselves. Now, the smarter objection. Maybe you don't follow gurus, maybe you follow valuations. The CAPE ratio is at bubble levels. The math itself says a crash has to come. Here's the problem with that. The CAPE ratio, price compared to 10 years of company earnings, has called the U.S. market expensive almost without pause since the mid-1990s. It sat above its classic danger line from 1995 to 2002, and again from 2014 until today. An investor who sold at the first warning missed some of the best decades in market history. As a tool for the next 12 months, CAPE is close to useless, Measured over the last 40 years, the relationship is practically zero. It tells you something about the next 10 years of returns. It tells you nothing about tomorrow. A high valuation is a weather report, not an earthquake alarm. And now the honest other side, because this is not a video claiming crashes are fake. Crashes are real. The market has fallen 20% or more roughly 27 times since 1928, and it will absolutely do it again, maybe this year, maybe in 10. The average bear market takes about a third off your portfolio. When the next one arrives, the perma-bears will step forward and say they predicted it, and then away they did. 9 out of the last 5. The real lesson isn't ignore risk. The real lesson is that the timing cannot be known. Not by you, not by a doctorate, not even by the man from the movie. So you stop preparing for a date and you start preparing for a fact. That looks boring, which is exactly why nobody puts it in a headline. An emergency fund, 3 to 6 months of expenses, so a crash never forces you to sell at the bottom. A stock allocation you can actually survive. If a 30% drop would make you panic, you own too many stocks today, not after the next warning, and rebalancing once a year, which automatically makes you sell what got expensive and buy what got cheap without a single forecast involved. That's what real risk management looks like. It needs exactly 0 predictions. And when the next profit appears on your feed, and he will probably this week, run one simple test before you feel anything. Look up what he predicted last year. And the year before that, check what happened to the people who acted on it. If you find a long list of crashes that never came, you're not looking at a forecaster. You're looking at a business model wearing a serious face. One line to take away. The crash profits are never wrong forever, because the market always falls eventually. But you don't live in eventually. You live in the 20 years in between. Michael Burry saw the biggest crash of our lifetime coming, and even he couldn't do it twice on schedule. If he can't time the market, the man on your feed can't either. If this saved you from one panic sell, subscribe. Next time, we take apart another comfortable story the finance industry sells you. And tell me below, what's the scariest market prediction you almost acted on? I read everything.